Unit Trust, StashAway, which is better? Welcome back to Mr. Money TV, the channel that makes financial knowledge fun. Okay, let's get to it. What is Unit Trust? Unit Trust is a fund that invests in a collection of securities, usually stocks, bonds, and money market funds. The fund is divided into units, so when you invest in the units of a unit trust fund, you invest in the units of the fund rather than the underlying asset. Your money, along with other fellow unit trust investors, will then be actively invested and managed by a professional fund manager. What about StashAway? StashAway is a robo-advisor platform from Singapore. A robo-advisor is similar to unit trust, whereby they are collective investments that pool investors' money together to invest into different assets. Most unit trusts will use a human advisor or agent to sell or advise unit trust investments, whereas StashAway uses a robo-advisor which employs automated algorithms to provide you with investment advice on asset allocation. Another difference is that while unit trust funds actively invest in a collection of securities, StashAway invests in exchange-traded funds or ETFs, which track a particular index like the S&P 500. So how do they both work? For unit trust to get started, you have two options. Number one, meet a unit trust agent or financial advisor, or number two, pick your own fund. If you're someone who has zero idea about how unit trust works and what funds to pick, consider option one, where you can share what your risk appetite, investment goal, and investment timeline are, and the unit trust agent / financial advisor would recommend several funds for you. If you know how unit trust works and what funds you want, you can use a platform like Fund Supermart to select your own unit trust fund. There are many types of funds out there, the most common one being these. You will then deposit your money, at least 100 ringgit, into the fund, and the fund manager is tasked to grow the value of the fund. Profits in unit trust come in two forms: increased NAV or net asset value, which is the price of each unit in the fund. For example, if you invested in the fund when it was 2 ringgit and 50 cents and now it's 4 ringgit per unit, you have made a 60% return. And number two, dividends, which are bonus units given to you. For example, you've bought 1,000 units and a few years later, they give to you 300 units as dividends. For StashAway, you need to register an account with StashAway, and then you need to download the app. From there, you'll be asked several questions regarding your financial status, financial literacy, investment goals, and risk appetite. After the questionnaire, you'll be given a recommended risk index level ranging from 6.5 to 36%, depending on your financial literacy. Your maximum risk level may be capped to either 14% or 22%. You will then need to deposit your money in, and your money will then be passively invested into different ETFs based on the risk index you've selected. Profits on StashAway also come in two forms, which are number one, capital gain, which can be realized if you take profits when the ETF prices are higher than when you initially deposited your money. And number two, cash dividends, which are given due to ETFs holding specific dividend stocks. StashAway will then reinvest the extra money back in, thus increasing your holding power. When it comes to fees for unit trusts, because there is a professional fund manager actively managing the fund, you can expect several charges. These are the common ones you should be aware of. To give you a brief description of each, management fees is the expenses of having a professional fund manager manage the fund for you, which can range from 1.25% to 1.8%. Sales charge, also known as the initial fee, is fees you pay as a setup cost for investing in the fund, which is typically at 0% to 1.75%. And even when you want to move money into another fund, you will be charged a fee, and this is called a switching charge, which is usually 50 ringgit per switch. And when you plan to redeem your investments, you will also be charged an exit fee, which typically reduces the longer you keep your money there. As you can see, that's a lot of fees. Therefore, in order for your unit trust investment to be profitable, your returns would need to be higher than that combined percentage. And as for StashAway, there are zero fees when it comes to registration, exit, withdrawal, and portfolio switching. The fees you pay come from management fees, which range from 0.2% to 0.8% annually, which decreases the more money you invest in it. Another one is currency conversion fees, which is 0.1% on the spot rate, and an expense ratio fee, which is charged by the ETF manager at roughly 0.2%. So, which is better? If you're looking for the human touch, to have a financial advisor to sit down and listen to your financial concerns as well as give you recommendations, and you want your investments actively managed, and you don't mind paying the fees, then go for unit trust. But if you're not concerned with the human touch and you prefer a more DIY and passive approach, plus you are kiam siap, then you could stash away your money with
StashAway.
Do you prefer unit trust or StashAway? Tell us why in the comments below.